Good morning and welcome to your Thursday, September 19th market news update. The Federal Reserve opted for a jumbo 50 BPS cut as a starting point for its journey towards looser financial conditions. Interest rates are expected to kept steady at the 5% level by the Bank of England later today. New Zealand's economy contracted by minus 0.2% in the second quarter of 2024, pressing the Kiwi lower. The Bank of Japan is expected to keep rates unchanged at 0.25% at tomorrow's meeting of September. Yuan traders brace for the PBOC's rate decision in tomorrow's early Asian session. Surprise cuts are speculated to prop up domestic demand. European and Asian stocks react positively to expectations of lower interest rates expectations from major economies. Finally, silver and gold rebound, recovering losses made post the Fed's decision. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 19th of September of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first topic of conversation is going to be a small summary of what has happened with the Federal Reserve's interest rate decision during yesterday's session. So let's just dive right in. So yesterday, the Federal Reserve officially switched gears and kick-started with resolve its easing cycle, pivoting away from these austere, years-long tightening practices. So FOMC policymakers assessed that sufficiently enough progress has been made on the inflationary front as price pressures headed steadily towards the 2% level, and that a severe downturn in the labor market efficiency could destabilize the US growth. And in a sense, if these rates remain higher for longer, this could lead to destabilization of the growth trajectory of the United States. Hence, they said, you know what, let's just go ahead and start slashing rates, even though we're not 100% sure that inflationary pressures are, this problem has been resolved, but still it's sufficiently good enough. So the committee opted for a jumbo, and this was a quasi-surprising jumbo 50 basis point cut, we must say, which was the first in the 4 years and has dragged down the federal funds rate to the 4.75 to 5% level. So yesterday we noted that there was a debate about a 25 or a 50 basis point cut. Majority, quote unquote, majority of the market, so 2/3 of the market expected a 50 basis point cut, while the remaining 1/3 expected a 25. So a quasi kind of surprise here. But still, this was a decisive unanimous and not restrictive, but with resolve enough kind of decision from the Federal Reserve. And that's why afterwards we saw and heard Venture Power saying, you know what, do not take this for granted, that now we're going to be slashing 50 BPS each and every meeting from here onwards. This has been a one-off kind of scenario just to start things going. From there onwards, this is not the norm. Do not expect 50 basis points. That was the attempt of Venture Power post the decision to just calm the market, because we have seen futures, equities, Precious metals, commodities, currencies just violently fluctuating during yesterday's session. They ended up kind of flat, but still in today's session, we have seen the markets going further away from here and saying, you know what, yes, fair enough. We expect further cuts from here. We're going to do our thing and just start pricing in more cuts to follow. So the dot plot, speaking of cuts to follow, the dot plot graph in the economic projections kind of document showcase that policymakers have penciled in a total of 100 basis points of cuts for the remainder of 2024, excluding yesterday's decision. And since yesterday we saw a 50 basis point cut, that leaves us another 50 basis points of cuts for the remainder of 2024 in the November and December meetings. Possibly we're going to see 25 basis point cuts from this Federal Reserve rather than another 50 straight away. Okay, but still, depending on the information coming in, this may alter. For the time being, 2 batches of 25 basis points in November and December are expected. As for what's to come in the future, the dot plot showcase that in 2025, a total of 100 basis points, so 1% in a sense of the federal funds rates is going to be slashed. Okay, and finally, a 50 basis points is expected for 2026. So we're talking about 100 for 2024, 100 for 2025, and 50 for 2026. So in total, we're talking about 2.5% of rate reductions expected, at least from the Fed going forward from here. So that possibly will leave us with, I know it's quite some time in the future. So in 2026, we may see in the United States a federal funds rate of 3 to 2.75 to 3%. So again, there's a lot more ground to be covered, a lot more things that could unfold. For the time being, this is the data we have. So as for inflation, PCE was revised lower to 2.3% for 2024, 2.1% for 2025. And in regards to GDP growth projections, 2% is expected for 2024 and the same kind of rate for 2025. That's kind of the ideal scenario in the eyes, at least from our point of view. So not sacrificing, in a sense, growth rate, albeit the unemployment rate being projected to rise up to 4.4% in 2025 and 26, if I'm not mistaken. So some sort of destabilization in the labor market is expected, but growth trajectories, for some reason, expected to be maintained. We'll see. So the dollar has indeed swung erratically during yesterday's session, yet settled flat near the end of the session. However, in today's session, we saw a light kind of reaction taking place, pushing the world reserve kind of currency back towards to 14-month lows. We also have seen equities wavering, closing the session marginally down in the reds yesterday. However, in today's session in the pre-market, we have seen equity futures jumping significantly higher, soaring to higher ground, with all 3 major stock market indices recording north of 1.5% each. So all of them are in the greens, and 2 of these indices, we're talking about the S&P 500 and Dow Jones hitting fresh record highs. Nasdaq is not there yet. Tech sector has been beaten down, and we have seen a lot of divestments taking place, some sort of short selling activity taking place as well, mainly because they see the tech sector being in some sort of a bubble right now in regards to the AI rally. So for the time being, however, it's performing decently enough, not as good as Dow Jones and S&P. Okay, for the time being, enough with the Fed. Let's move on to the next topic of conversation, which is going to be about the Bank of England, which, in a sense, they have their own respective interest rate decision in today's session, possibly the main event of the day. So the next major central bank to take the stand in this indeed policy-packed decision week is the Bank of England, and pound traders are expected to tune in for definitely valuable clues. So polled economists and money market participants and forecasters expect the central bank to take a knee in today's session and keep the overnight borrowing rate unchanged at the 5% level after commencing their easing cycle in the July meeting, where we saw a 25 basis point rate reduction. So a pause is expected, and this is reflected in the pound OIS probabilities, where the pause scenario is currently amassing approximately 75% chance. However, going onwards from here, we see money market participants expecting 25 basis point rate cuts in the November and December meetings, gathering a 65 and a 60% chance probabilities respectively. So whether we will see a cut or a pause in today's session, that is to be determined by how confident the Monetary Policy Committee, the MPC Committee of the Bank of England is. Inflation has eased to the 2.2% level according to the latest data we have seen in regards to the UK's economy. But we have seen at the same time policymakers and Governor Bailey, more specifically in the prior meeting, but also throughout these past weeks, indicating that they do not currently feel confident about price pressures, more specifically about them easing steadily down towards the or below the 2% target anytime soon, since and hence they decided to just side with caution and accounting in a sense indirectly for the upside risks of inflation reigniting. More specifically, we're talking about services inflation, which has been steadily going upwards in recent months. This is the primary kind of problem of Bank of England's policymakers. So speaking of them, of importance is always going to be the speech of Governor Bailey, who is going to comment and communicate how the Bank of England is seeing the situation currently and what is to be expected in the coming meetings. But also of crucial importance is always going to be it's also going to be the monetary policy, the MPC vote count, and we will see whether policymakers, for some paradoxical reason, which is some reason not weird, whether they're gonna align and have the same kind of outlook and all of them go for a cut, possibly not in today's session, but possibly in the next one. The vote split is definitely going to be important, and we're going to see a 5 and 4, 5 in favor of a pause and 4 in favor for a cut yet again, or is this kind of dynamic going to change? Because this has severe implications on how international investors perceive the Bank of England and their kind of unanimity, if you like, or are they acting in unity or not? Okay, so finally, we're going to talk about the pound, which has capitalized on the weakness of the dollar during yesterday's session, mainly because of the weakness coming from the jumbo 50 basis point cut from the Federal Reserve. Cable is now trading close to the 1.33 barrier, and this is an area last visited in March of 2022. So we're talking about what, 2 and 5-6 months, or so 2.5 year highs. That says a lot. If we see the Bank of England staying on hold in today's session, we would reasonably expect to see the pound heading north from here and possibly into higher territory. Okay, for the time being, we're going to keep it here, guys. Thanks for watching, and we will see you on to tomorrow's session for another monetary policy decision, because we're going to have Bank of England, not Bank of England, excuse me. We're going to have the Bank of Japan and PBOC, the People's Bank of China, in tomorrow's early Asian session, delivering their respective decisions. Probably the topics are going to be those two, plus so more summary of what has happened with the Bank of England today. For the time being, take care. Bye-bye. Hi, everybody. Welcome. I apologize for the delay. Okay, so I see people joining in. Welcome, guys. Again, I apologize for the slight delay. I had some issues with the PC, unfortunately. Fortunately, that is way past us now. So perfect. Okay, so everything is up and running correctly. Let's begin. So welcome, guys, to another webinar of our series. This is the second one. Last week we've done introduction to trading. In this webinar, we're gonna expand from that. More specifically, we're gonna talk about technical analysis. It's going to be a brief, basic, and I'm outlining it from the beginning, brief and basic outlook or outline of technical analysis. This is for you to just dip your toes into this vast water of what we call financial markets. We're going to do technical analysis. Again, super basic. And something else I forgot to mention, if you have any question whatsoever, please let me know in the chat. Okay, feel free. If you have any question, if I'm talking too fast, if I'm outlining something and you didn't understand, the deal, don't be embarrassed or shy. Just send them through, okay? The chat is working, so that's perfect. Okay, so again, kickstart the whole thing. Introduction to technical analysis. This is a quick risk warning and a disclaimer. I'm not going to go over this. The gist of it is in any ways that these materials just for educational purposes only. It contains no investment information or investment advice whatsoever, purely for educational purposes. Okay, so enough about this. Let's move on into the nitty-gritty detail. Okay, so this is going to be, if you can hopefully see the slide of the presentation. This is the outlook of what we're going to go over in this session. Okay, so we're going to start with a question. What is technical analysis? Are there any different types of technical analysis? If yes, what are they? We're going to present them. And which approach might work best for you? That's something else we're going to address. And we're going to combine, in a sense, what we're going to outline in front of you. Okay, so let's go on with a brief and simple introduction to what technical analysis is. Let's see a definition. Okay, hopefully you're going to get the understanding from this. So technical analysis as such is the study of market action through the use of charts. Okay, so we as technical analysts look at charts. What are those charts? We're going to see. So in order to forecast future price trends, this is what we are actually doing. We're looking at charts and we extrapolate and we analyze and we highlight specific kind of trends or movements that the market or specific instrument is doing, with the goal in mind is firstly, obviously, to understand it and then project onwards into the future what's going to happen. And once we come up to an assessment, a viable assessment with a high degree of probability, we take action from there onwards. Okay, so we capitalize upon this expectation. So again, technical analysis deals with charts, and the primary interest is for you to judge or predict or foresee future price trends. So in this market action, what we call market action, includes three key elements. And these is price, the most important thing of the whole aspect of technical analysis. Price is the first and foremost. We also have volume, superbly important as well, but it is complementary to price. That means if you don't look at price and you just look at volume, you're not getting the full picture. So looking at price and then volume gives you an extra lens or clears out the vision in front of you, if you like. And the third one is open interest, also another subsidiary or another extra component that comes into the question, into the mix, is open interest. So technical analysis indeed can be used in all time frames. And if you remember last webinar, we have the webinar, the structure of the webinar asked a few questions which were directed towards you in order to understand what kind of trader you may become. Obviously, it's up to your liking. So we introduced the concept of time at that webinar, at the pre-webinar. So time pretty much dictates what kind of trader you're going to become. Obviously, there are exceptions to the rules, but what I mean by the concept of time. So if you have, for example, the proclivity to become a scalper, okay, that means you open and close positions in a very, very short time frame. Okay, so usually minutes or at max an hour, and you capitalize upon short price fluctuations, and you capitalize on that. So the concept of time comes in play because you're looking at the short, super short horizon, if you will, like, of that specific instrument. If you are, for example, a long-term trader, you're gonna or a swing trader, you're going to be looking at different time frames. You're going to use different kind of methodologies, if you will, like, and a different approach when it comes to trading. So at the end of the day, technical analysis can be used from scalpers, from day traders, from swing traders and long position traders as well. Everyone can use technical analysis, but okay, it's a big but. You have to zoom in on a specific time frame in order to match your proclivities, or zoom out in order to, if you have a longer time horizon, adjust that by doing technical analysis. But it can be used for pretty much any given time frame. If you pull up a chart on your MT4 platform, you're going to see that you have time frames ranging from 1 minute to 5 minutes to 15 minutes to half an hour, 1 hour, 4 hours, daily, weekly, monthly, whatever that is. You can do technical analysis. The principles of technical analysis apply on all time frames. Okay, but there are, again, exceptions to the rules. For example, long-term trends usually, okay, are obviously long-term. They take a lot of time to materialize, and you can use this information accordingly. Short-term time frames are a little bit much more volatile and unpredictable, and can cause you to lose money quite quickly. But at the end of the day, if you know what you're doing, if you learn all these kind of lessons that we're going to introduce over the future, you're going to have, again, at the end of the day, because trading is it's a probabilistic kind of game, you're going to have higher probabilities in your favor and place trades. Okay, I'm not going to comment on this any further. So technical analysis can be used in all time frames for short-term, medium-term, and long-term trading. And technical analysts, at the end of the day, develop trading rules, and we're going to discuss about this, and trading systems by using various theories, charting tools, and indicators. Okay, so hopefully all of you guys are familiar with the charting tools and indicators. The theories are a little bit more vague and generalistic, if you will, like, but again, super important to know as well. So most of the times throughout these webinars, yes, we're going to introduce various concepts and various theories. We're not going to focus a lot on that. We're going to do a lot of deep dives on indicators, technical indicators. Again, super easy to apply to your charts and give you the information. The information is there for you to decode, and we will decode that together. And charting tools, really super simplistic. Technical analysis, kind of path, draws trend lines and support and resistance levels, and highlighting these areas and channels and all that kind of stuff. We're going to look at as well. So, okay. So moving past this, if there's something, that is beneficial for you to learn and comprehend and digest from the beginning, is that these three key principles that I have outlined down here. They are best said or best represented as let's just say words of wisdom that were gathered by traders over long periods of time, they have been in this market, in this tumultuous kind of unpredictable game for long enough. They came up with their own sophisticated kind of takes on what technical analysis is and how the markets are behaving, and these are three prime examples. For example, the fact that it's not a fact, but is not a rule written in stone. It's just a truthful observation. Let's just put it that. Okay. So the market discounts everything. Okay. So this comes from some groundbreaking kind of studies that were conducted back in the 1950s, where the concept of the efficient market hypothesis was firstly introduced into the market. So in a sense, in a gist, with simple words, this means that any given available information that is presented to the market, let's just say right now, is going to be not instantly, but within a short period of time, is going to be implemented and incorporated into the price action. So therefore, if this guess or this is assumption is being held true, that means that the market inherently reacts to this kind of news as soon as possible, incorporates this kind of information, and there are no quote unquote profit taking opportunities. So this is an exception to the rule. There are a lot of opportunities out there. The market does not move as efficiently as that theory was has said it is moving, but from a general point of view, and given enough time, the market does indeed discount everything. It does incorporate all available information into the price action. And what we're dealing here with technical analysis is trying, in a sense, to find these opportunities where the market does not move fast enough and capitalize upon that and act accordingly, place trades according to this. Okay. But the overall kind of overarching theme is indeed true that the market discounts everything. Okay. So another key principle is that the price moves in trends. Without a doubt, from my point of view, this is one of the biggest truths that can be observed if you look long enough into the markets. Maybe you're not going to look long enough, you're going to see that the price action does indeed move in trends, and hence, if it does move in trend, okay, there is a quote unquote predictability aspect to the market. So if indeed the market moves in trends and you can spot the trend, you can identify the trend and analyze the entire thing, that means the whole thing becomes a little bit predictable. So if it becomes predictable, you can actually take action on this. Okay, so in a sense, you have high degree of probability. You know what? I've studied this kind of trend. I've seen this trend manifesting and taking place many times in the past. I know how to deal with it, and therefore I actually take action on it. Okay, so something else I'm gonna add on this point that I'm personally gonna be talking a lot about throughout this webinar series is that if you are indeed a new trader in this kind of game, in the trading game, if you are a new participant in this kind of trading game, it's highly recommended, or at the end, this is my point of view. I'm not going to tell you what to do. It's highly beneficial for you to start identifying the trends and trading with them. So you're going to hear a lot of euphemisms that the trend is your friend and all that kind of stuff. That is certainly true. If you are new to this game and you don't have your, let's just say, fundamental knowledge up to a specific level, and you're pretty much trying to act within the markets with a lot of guesswork, trust me, you're going to find yourself on the opposite side of trades many, many times. So again, it's an unwritten rule in stone. Trading with the trend is the most quote unquote safe way to start trading. So again, up to you if you want to be a contrarian and just short things at the top of the markets because you feel that the move has gone way too ahead of itself. Feel free. Your money, your rules, your game. Okay, so I'm just outlining a few concepts here. So the third and final principle out of many, I've just chosen three here, is that history tends to repeat itself. Okay, again, this is another quote unquote fact. And by making this assumption, making way of this kind of principle, again, it comes down to predictability. So if you studied long enough past price action and you have duly done your due diligence, okay, and you know what has happened at that specific point in time, and you know what the macroeconomic environment of that economy was this and this and this, and I see similar factors and similar parameters taking place right now. Again, I'm expecting that the market is going to react to it same kind of manner, which makes it predictable, and therefore you can go ahead and act upon this knowledge or this intuition or this assessment that you have created. Okay, so again, these are three basic principles: market discounts everything, price moves in trends, and history tends to repeat itself. And these are the building blocks of the whole rationale or the whole school of thought of technical analysis. We take these quote unquote for granted, or we take these assumptions with a grain of salt, and we conduct technical analysis in financial markets in order to, again, what's the end goal of this? To make profit, okay, to capitalize upon these moves of these inherent kind of principles that we see. Okay, so enough about the theory. Let's see what are the different types of technical analysis. Okay, so again, this is my way of splitting the category of technical analysis into two hopefully easily digestible kind of branches. So on the left hand side of your screen you have charting analysis. We're going to talk about what it is. Mechanical analysis is on the other hand side. Again, both are components of technical analysis. Okay, so they are attempting to do pretty much the same thing. However, some things are more beneficial than others. They have their own usage. So you can conceptualize these kind of two categories and the components that go behind them as tools. Okay, easily available and free of to use tools that you can deploy at your disposal at any given time when you do technical analysis. Again, they have their pros and cons. We're going to see them. So when we talk about charting analysis, again, we mentioned on the first slide that technical analysis is conducted by the usage of chart. So charting analysis is primarily looking at what price action, volume, and open interest. And charting analysis, more specifically, the tools that you have available in your arsenal are support and resistance levels. So in a sense, in other words, areas where you have, if you studied the past history of price action, because essentially at the end of the day, what information does the chart convey to you? So if you look at the x-axis, the one on the bottom, it has time, and on the y-axis you have price. So it's a visual representation of price across time of that specific instrument you're looking at. Okay, so it gives you a story of what has happened specifically in regards to the price action of that specific instrument across time. Okay, so when you look backwards, you in a sense look at the quote unquote movie that was played out, the moves that were played out. And once you start studying that and you understand what has gone over with this kind of instrument, and look underneath the surface and see, oh, you know what, when this thing happened, when this report came out, or when this geopolitical event happened, or with that monetary policy decision from a central bank came out, it happened this, and it had this kind of reaction: A reaction, B reaction, C reaction. So what you do in this kind of environment, you are, from a purely looking at the charting analysis kind of lens, is that support and resistance levels are areas on that past price action that you saw the price failing to move above or below. Okay, if you see an instrument hitting, for example, a price level 3 or 4 or 5 times and it doesn't manage to move above it, you can clearly see and state and brand this kind of area as a resistance area. And the reason why you do that is because you need to pay attention to that kind of level, because it's of significance. And once it reaches to that level, once again, you can make your own assessment. You know what, is this the 5th or 6th time that the price action is going to break above? Or we're going to see exactly the same thing. We're going to see the price action hitting that level, come back hitting, and it's going to be one of the same, and you're going to see the price action moving to lower ground. Once you start identifying and marking those levels onto your chart, you have an indirect kind of hint behind your mind telling you, you know what, I'm going to pay attention to this. And once that level is reached, once again, you can take action upon that, whether go long or whether go short, depending on the situation. Again, support and resistance levels are used. They are visual, highlighted areas that you place on your chart in order for you to pay attention to these levels and not miss them out, and actually take action once price action reaches that level. Okay, so it can be used for entry and exit points and many other has many other usages, but we're going to see them in next few webinars in much more depth. So other tools available at your arsenal when it comes to charting analysis is what we call trend lines. Super basic straight lines that you're gonna start drawing on your chart, which are gonna, again, visually help you, visually aid you to, to see clearly, the price action is moving to higher ground because I see higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Okay, you see peaks and troughs, peaks and troughs, peaks and troughs. You draw a trend line on the bottom of the higher lows, clearly telling you that the price action is moving to higher ground. So you, in a sense, establish the direction of the trend. And once you establish the direction of the trend, you can actually capitalize upon that and trade. Okay, that's why we use trend lines. They don't have any sort of future predicting abilities. It's for you to just visually confirm the current trajectory of a trend. Okay, and again, we mentioned the prior slide. Best thing you can do if you are a beginner is trade with the trend. So once you identify the trend, the next thing is to trade. Okay, so there are many other steps involved, but I made it way too simple. So charting analysis has another tool, for example, channels, which are pretty similar to trend lines, and you can see the price action being revolving between these two bounds. You have a level above and a level below. Let's just say it's a sideways moving instrument. That means, when we say sideways, means it bounces between a range of values and does not exceed it. Let's just say between $10 and $20, and you see the price action being stuck within these two bounds. This is a channel, okay? And you can play according this. You can develop a strategy according this. If you spot this, for example, to go short at the top of the line, the channel, the $20, and have to exit the position at the $10 or buy at the $10 mark and say, place your take profit or sell order to net the effect and make money by placing it near the upper bound at $20. Okay, super simplistic, but channels is another pretty useful tool that you can develop or deploy at your own liking at any given time you want. Okay, so something else we're going to look at when we going to be talking about charting analysis more specifically in the next few webinars, it's going to be chart patterns. Super important. Okay, and the reason I'm going to give you the backstory to understand the reason why it's super important, especially if you are dealing with traders that specifically technical analysts that have been doing this for many years, or they have a lot of experience. There is a phenomenon that kind of arises when you see a specific chart pattern kind of ending its formation. Okay, most of the times many times the formation of that specific pattern is being forced to be formed. And what I mean by this is that once you have a group of people or many people or technical analysts knowing the same thing, for example, a head and shoulders chart pattern formation, okay, when you have price action rallying, okay, then dipping a little bit, making a new high, dipping below once again, and failing to once again make a new high, but the shoulder in a sense is at the same level. Before the actual pattern is finished, okay, with the price action falling from the right hand side of the chart, you see traders jumping the gun because, oh, you know what, they spot this pattern and they actually force it to happen. So this is what we call a self-fulfilling prophecy. So when enough traders see the same thing, they tend to act with the same thing. And if you have a large group of people acting the same way, again, falls under the predictability kind of realm. And if it does fall under the predictability kind of realm, you can capitalize upon that. Okay. Point is to know your chart patterns. There are a lot of them out there, but unfortunately, we're not going to have enough time in the next few webinars. I'm going to provide you with a lot of examples of the most widely known ones and the ones that tend to create this kind of forced completion, this self-fulfilling prophecy I've just mentioned. But knowing your chart patterns gives you definitely an edge, because you can extrapolate and anticipate that this may happen. Obviously, you're not sure. You have a higher degree of confidence rather than not spotting the chart pattern. That's the point I'm trying to make. Okay, chart patterns, we're going to do a lot of them in the next few webinars. Okay, so enough about charting analysis. Let's move on to the next category. Again, I like to split in two ways. Maybe you can put all of this together. For me, it's easier to digest. Okay, so you have the other category is mechanical analysis. Okay, oh, something else I failed to mention, pardon me. When we talk about charting analysis, all these tools that we have mentioned right now, okay, support and resistance levels, trend lines, channels, and chart patterns, all of that is on top of price action. Okay, this is one of the key differences between charting analysis and mechanical analysis. Okay, again, that's a generalization, but mechanical analysis, more specifically, it encompasses a lot of mechanistic, algorithmically created kind of indicators. So these are, if you can say, this is code that has been pre-programmed to spit out a specific value or create a specific oscillator or indicator that tells you something else that you might have not been easily spotted with the naked eye. So technical indicators are, in a sense, definitely super beneficial tools that you can put on your charts. And most of them, there are a lot of them out there. We have to note this from the beginning. Now, which ones are the best is up to you and up to your liking and your interpretation. But there are, again, many categories that divide technical indicators. You have momentum oscillators, you have strength indicators, you have volume indicators. They are attempting, in a sense, to explain a specific phenomenon or a specific, let's just say, habit of price action. I'm not sure whether that is the right word, but yeah. So when we talk about mechanical analysis in this webinar series, we're going to talk a lot about moving averages. Super easy concepts to digest, super and easy concepts to obviously deploy to your chart, but also trade with them. We're going to introduce the simple moving average kind of strategy that pretty much works decently enough. We're also going to do a two moving average kind of strategy, which works a little bit more better. We're going to talk about bullish crosses and death crosses, how to spot them and how to trade them. We're going to have webinars on that. So another aspect or another component that falls under mechanical analysis are oscillators. Going to talk a lot about them. I'm a big fan of those. They convey a lot of edgy kind of information that I like to look a lot upon them, and just gives me, from my point of view at least, it works. So it gives me, quote unquote, an edge. We also have bands and envelopes. These are indicators that are stemming from how am I going to say, the way they have been constructed are based on statistics, and more specifically, when we talk about bands, you're gonna introduce the concept or the indicator of Bollinger bands. They are, in a sense, using statistical means to see whether a specific move has been an outlier or whether it's a common kind of trend moving kind of move. Again, there's no point of going deeper into this. We're going to see them into the next webinar. And other technical indicators, for example, we're going to go over the relative strength index, okay, gauges momentum. We're going to do moving average, convergence and divergence. We're going to do Ichimoku clouds. We're going to do Fibonacci as well. There is a lot of them out there. Hopefully, we're going to have enough time to cover them. Okay, so the point here I'm trying to make is that technical analysis is a big subject. There are a lot of tools available at your disposal. The point is to become familiar with a few of them that are actually complementary to each other, and use these plethora, or at least the 1, 2, 3, 4, 5 technical indicators and charting tools that you're going to use on your chart to give you confidence in your scenario building abilities. Now, if you have a chart and you have 15 different indicators on it, and when you look at the chart, you get panicky, there's no need for you to have all these kind of indicators. Most of the times you need 3 or 4, maybe 5 technical indicators. Okay, and the 5 are pretty much a stretch. 5, let's just say 3 or 4 that are conveying different information to you. Okay, which are possibly they're going to give you an edge, and by looking at them, you're going to gauge the market much more nicely, and they're going to see, and you're going to make your assessments and your scenarios. And if those technical indicators kind of align and they're telling you the same exact thing, you have what we call a high degree of probability of placing a profitable trade. So at the end of the day, this is what you need. You don't need 15 different indicators telling you all over the place, telling you I'm sorry, they're going to be on your chart, 15 different indicators, and you panicking and not seeing, no, knowing what to do because you have overstimulation of information. Okay. At the end of the day, we don't need that. We need to have clear minds and clear eyes when we look at markets, because it's a deeply chaotic place. We just need certainty rather than too much, rather than the uncertainty. So the point here is with technical indicators and doing technical analysis, please keep it simple, easy for you to comprehend what kind of information they tell you, and from there onwards, act upon it and capitalize upon it. Okay, no need to just, you know what, look at my chart, how cool it is. I have 15 indicators on it. Okay, have 12, have 20. What does it matter if when you look at the chart, you get confused? No need to do that. Okay, and we will discuss which indicators are complementary with each other or which are exactly the same and you have 4 of them. There's no need to do that. Okay, so we're gonna introduce a lot of them throughout this series. Okay, so since we talked about charts and technical analysis is primarily conducted, not primarily, it's entirely conducted on charts. We're going to introduce a few of them here. We have what we call a line chart, a bar chart, and a candlestick chart. There are many of them. You have pivot points. You have, okay. We're going to keep it simple. Line chart, bar chart, and candlestick chart. These are the 3 most widely known ones. Maybe not the most widely used ones, but still. So a line chart is the simplest of all charts. So the line chart consists of only a single line which connects a consecutive closing prices. Okay, so it doesn't give you any information about where the price has opened, okay, how far the price action has went, or how low or how high the price action has went. It just connects the dots between closes. Okay, so from this one, this statement alone, you can see that the line chart is the simplest out of them, but is also the most quote unquote useless. Okay, the line chart does have a lot of usages due to its simplicity, but at the end of the day, it not eliminates, but it does not include a lot of or a lot of other aspects of price action that once seen may have given you an edge. Okay, so I've seen people trade on line charts, very few of them. However, I've seen them, at least from what they've said, they are actually profitable doing it. Okay, might be something you need to use as well. I don't know. I like to see a little bit more stuff on my price action. I like the complexity. Some people do not. They like simplicity. Fair enough. If you can use this kind of chart and you actually do in fact make money, perfect. Kudos to you. Okay. So at the end of the day, back to the slide. Line chart does not provide any information about the trading range within the selected time interval, and trading range is once again how far the price action has went within the chart, or how within that time frame, or how low has the price action went before closing at that specific level. Okay, and these kind of highs and lows do in fact matter, because most technical indicators, okay, at least the most widely known ones, do in fact, or at least some of them, do in fact take into account the trading range. For example, ATR is an indicator that pretty much looks at that, okay, how low the price action has went. ADX, the average directional index, also uses the ATR. So once you have a chart that compiles that information, it's a no-brainer that you need a chart that also mirrors what the information goes within the indicator. Okay, so again, line charts are done. Remember them all. The thing you need to remember is that the simplest out of them all, you can actually trade, gives you simplistic wave of where the market is moving. So bar chart is, we can call it a more advanced version of the line chart. The bar chart is visually represented on the slide right on your left-hand side of the corner. What information does the bar chart convey? You can clearly see that on the right-hand side, you have what we call a bullish bar and a bearish bar. A bullish bar means price action has went up within that time frame. Bearish bar, that means the price action actually went lower. How do you distinguish that? Okay, so let's talk about the components of the bullish bar. So you have obviously a line, okay? Open price is always on the left-hand side, and you can see this kind of small protruding kind of line on the left-hand side. Always is going to be the open, and on the right-hand side is always going to be the close. So whenever, okay, even if your chart, even if your for example, look at the chart on the left-hand side, even if it's black without colors, you can clearly see, if you understand how these candles are formed, these bars are formed, which ones are the bullish ones and which ones are the bearish ones, purely looking at those protruding kind of lines on the left-hand side and the right-hand side. So whenever you see, I don't know if you can actually see my mouse pointer. Can you see that or not? If not, okay, I'm gonna just briefly verbally guide you. So if you look on the right-hand side of your slide, you have the bullish bar, the open. Okay, when you have a bullish bar, the open price is always, okay, lower than the close price. Okay, that makes sense, doesn't it? So if indeed the price action went from the market open and close above the open price, that is a bullish bar that is painted in green, easily seen. For example, the last candle you can see on the chart, okay, it's not a bullish bar, it's a bearish bar, because the open price, okay, is higher than the close price. Okay, and this is how you can spot which is a bullish or a bearish candle. So bullish bar, the open price is lower than the closing bar, the close price, and the bearish bar is the open price is higher than the close price. Okay, pretty simple, pretty easy to digest, hopefully. Yeah, if not, please let me know. If indeed is clear, I'm going to move to the next slide, which is I'm going to make an assumption. This is the most widely used chart that is out there in recent days. Okay, so the line charts and the bar charts were used in the past. This is the chart that most traders, at least the ones I've seen, are actually using. This is called the candlestick chart. Okay, it's pretty much the same as the bar chart that we looked up beforehand, with the exception of the candlesticks do have what we call a real body. So if you look at these bullish bar, it's just a stick, it's just a straight line, okay, and you have open a small protruding line on the left hand side and the one on the other, highlighting the open and close. The candlesticks do not have protruding lines left and right, they just have a real body. okay, which is this thick rectangular kind of thing you can see on your right hand side with what we call a wick. So like a candle, the thing that you light up, the wick, what is it? The string that you light up is the top side, and the below line, okay, the lowest part, the lowest level that the price action has reached is what we call a shadow, okay, or a tail, like a tail's animal. Okay, so there are many words describing this kind of thing, but what you need to understand is that these lines, the small lines, not the real body, not the rectangular part, the actual small lines are highlighting on your chart or any given instrument on any given time how high the price action has went and how low has the price action went, okay, before closing either above it or below it. Okay, so you may see indeed a candlestick, okay, with only the real body. If the candlestick has only a real body without this, the shadow, without the wick and the shadow, that means the price action has opened at this point and then it closed at this point without going either higher or lower within the session. And the highest and the lowest of within that the price action has went within the session is superly important because it conveys you information about the tendency of market participants, of the bulls and the bears. Okay, wicks are most of the times an area of indecision or an area of fierce fighting between the bulls and the bear that they have not yet, let's just say, equalized. Okay, so you can imagine the creation of bullish and bearish candles, much like a game of tug of war. Okay, or ropes. You have a team on the one hand and the team on the other hand, and you have a rope, you have a marked line on the ground, and one team pulls and the other one pulls back. Okay, so let's just say one team is green and the other one is red. Okay, if that rope, if the green team pulls the red team past that kind of line, that means obviously the green team is much stronger at that point in time compared to the red one. That means with the same analogy, on your chart you're going to see a a bullish candle, a green candle. That means at that specific point in time, the bears were in control. The green team was in control of the move. The strength was way too much for the bulls, the red team, to handle, and they have won that temporary quote unquote tug of war game. That is one way for you to conceptualize. So, how far and how fast the rope gets pulled and okay by which team tells you a lot of information about the tendency of those that are actually playing the game. Okay, and we're going to talk a lot about candlesticks and in the formation of candlesticks and what makes this kind of game, what kind of different candles you can see on your chart and what kind of information they convey. We're going to see a lot of them in the next few webinars down the line with this series, because it's super important to understand how the whole thing unfolds. Okay, the mechanics behind the formation of candles, because if you understand the game that is played and who wins and who loses, okay, at that point specific in time, it gives you valuable clues about possibly where the price action is going to move towards next, because they do have sort of predictive abilities. And once you study long enough candlesticks, you're going to see that there are specific formations of candlesticks. For example, if you one, two, three, or one, two, four kind of candles back to back, and they make a specific formation, they tell you a specific story. And if you have read your story beforehand, if you have made your homework, you can actually reasonably predict where it's going to move towards to next. Okay, again, this is a big assumption. Okay, most of the times it unfolds like this. There have a lot of exceptions to the game as well, where candlestick formations are not actually conveying valuable information, and that what you expected to see is not going to come to fruition. Fortunately, that's the market. The market is dynamic and the market is chaotic. There is a lot of different components that are affecting it at all times. What we're trying to do is narrow it down and understand what's going on, and hopefully, with high degree of probability, make an assessment and place trades. Okay, so this is the end what we attempt to do at the end of the game. Okay, so when we talk about candlesticks, charts, and all that kind of stuff, again, we're going to look at them in the next few webinars. So I'm going to go over and read what I have in front of me on this kind of slide. So the area between the open and close is what we call the real body. Okay, the range and price excursions. Okay, the wicks and the shadows we just mentioned. Above or below the real body are called shadows and wicks. Okay, we're going to see a lot of them coming up. And candlestick charts are definitely visually superior to bar charts and line charts, and therefore they are preferred by traders. Okay, super simple, super basic. We're going to do the intermediate to advanced stuff next up. Okay, so again, this is a visual illustration of a candlestick chart. Most people use this, but at the end of the day, we need to not just set up a chart and say, you know what, I'm using candlestick charts. If you don't know what information do candlesticks convey, there is a problem. And what we attempt to do in this kind of webinar series is to solve this kind of problem, or at least provide you with the necessary tools to go ahead and comprehend what's going on and make much more nicer trades. Okay. So charting analysis, once again, support and resistance levels, trend lines, channels, and chart patterns. What is the next slide here? Okay. And let me see. Both sides. Okay. Oh, those are examples, once again, of the tools that we have available for with us, to us. Okay. When we're doing technical analysis, once again, charting analysis. Once again, we're going to do a recap. Charting analysis uses support and resistance levels. You're going to see them next up. Trend lines, channels, and chart patterns. And as we just mentioned, we have the category of charting analysis and mechanical analysis. I split the mechanical analysis into two parts as well. Okay, so we have what we call on-chart indicators. This is a chart. You're going to see indications coming above or through the price action. Such examples are the moving averages. Okay, and the other categories, the oscillators that come in a box below the price action. Okay, this is the main distinction. So this is a distinction we're going to talk about right now. So under the mechanical analysis categories, okay, we have two branches. Once again, on chart indicators, the ones that go on top of price action, so they merge with price action. Examples are moving averages, Bollinger Bands, Ichimoku Clouds, and Parabolic SAR. Okay, very lovely tools that you can apply to your charts and have possibly get an edge. We're going to talk about pretty much all of them out there in the next webinars. And we have the next category that falls under mechanical analysis. The second leg is we have what we call off-chart indicators. Okay, some of them are the relative strength index. We're going to cover this. Moving average, convergence, and divergence. We have the ADX, the average diagonal move, and pretty much the simplest of them all, momentum, super important as well. These are the ones that, again, go below the price action. You have the chart, the price action, blah, 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 and volume or whatever it is, and you have a different box below the price action, below the chart, which these indicators can be found in. Okay, and again, we're going to talk a lot about them coming up. So one other branch, it's not another branch, it's a technical indicator that is going on top of price action, on top of charts, is what we call Fibonacci. I don't know how many of you guys are familiar with the concept of Fibonacci. We're going to introduce that as well. And I'm giving you some outlines here. So some indicators that you can find and apply to your charts and can be useful under specific conditions. We have to mention this are Fibonacci retracements, extensions, expansions, and projections. Fear not, if you are confused about this, we can go in depth about this in some other webinar. We're just merely introducing what kind of available tools you have in this kind of webinar. Also, the Elliott wave theory, it's a lovely theory. It is complicated, it is sophisticated, it needs a lot of time, and attention to grasp how the whole thing comes out and what kind of information it conveys. If we assume that this kind of theory is indeed valid, hopefully we're going to do a webinar on this. I do not currently have content for this, but I'm going to do my best and come up with super basic and easy to understand kind of content slides for you, okay? Because it does have a lot of value. So what might best work for you? That is a question I'm going to leave you guys with. Again, you have a lot of tools that you can deploy into your chart. Something that I will, once again, I'm not going to advise you, but I'm going to just put out there. The sooner you get familiar with using this kind of technical indications, if you are willing, in a sense, to go down the technical analysis path and just focus solely on that, not incorporate fundamental analysis to it, is practice, practice, practice. Obviously, apply different stuff to your chart, play around, use a demo account before you actually use a real kind of environment account. Practice a lot, see what fits your kind of personality, which ones are helpful and which ones are actually giving you headaches. Use the ones, at least experiment and come up with the ones that are beneficial for you. And yeah, at the end of the day, it takes practice, practice, practice. But we are going to cover pretty much all of the ones that we mentioned in this kind of webinar. In the weeks to come, we're going to deep dive and break down each and every one of the components that create this kind of indicators. And once we do that, you can understand how they work, what information goes in and what information gets spit out. And once you understand that, you're going to understand essentially what information it conveys. If you understand what information it conveys, you can go ahead and gauge that information and place trades. This is what we attempt to do in this webinar, okay? In this webinar series, introduce them, put them on a live environment, see them together, what information they convey, etc., etc., etc. Again, learning purposes. You need to study a lot. Some of them are super easy to digest and comprehend. Some others are a bit more tricky, more demanding from you. At the end of the day, you do you choose which ones you like and which ones you don't, and create a plan with the highest degree of probability. We're going to make the best case scenarios by nearing the end of this webinar series, where you can put all of this together, assess what information are they telling you about, what are they conveying, make a best case scenario, and actually trade upon it. Okay, so hopefully this webinar has been indeed informative and not confusing. If it has been confusing, please let me know. I'm willing to fix this kind of situation. It would be nice to get some feedback. So if you do have any sort of questions, please guys, send them through right now. If not, I'm gonna leave you to it, and I'm gonna go ahead and write some lovely reports. And if not, if you don't have questions, I don't see any questions. Take care, guys, and have a lovely weekend and trade safely. Okay, for the time being, take care. Ciao, ciao. Bye bye.